Welcome to Concept Craft Accounting and Finance Lesson. You will learn the basics of accounting. By the end of this video, even if you know nothing about accounting, you'll be able to prepare financial statements like the balance sheet, income statement, and cash flow statement. You'll also understand how these statements are made and what they mean. By understanding the basics shared in this video, you'll be ready to start a job as an accountant. If you already have a job in accounting and want to clarify concepts for your day-to-day work, this video will be helpful. Watch until the end and let me know if you find the information useful. Subscribe to my channel and like the video so you can easily return to it whenever you need a refresher. Let's dive into accounting. Think of accounting as the way businesses talk about money. It keeps track of all the money that comes in and goes out. For example, when a seller sells a phone to a buyer, that's a money move, and there are special ways to write that down in the seller's money records. If the buyer is a business too, they'll write down that they bought the phone. Accounting is all about the rules on how to write these things down, which is also called bookkeeping. Let's break it down with an example. Money moves in business, debits and credits. Consider Bun Bites, our burger joint, which purchases lettuce for $285 to add a fresh crunch to their burgers. Along with this, they incur a $200 electricity bill and invest $2,500 in a new computer. These are all financial transactions that occur within a business. In the realm of accounting, every monetary transaction has two aspects, debit and credit. These are the fundamental elements that help track the flow of money. Understanding debits and credits. Debit. This is when a business acquires something or there's an increase in assets. It's like the business is saying, we have more of something, and it's added to the left side of the balance sheet. Credit. This happens when the business parts with something or there's a decrease in assets. It's the business's way of noting, we have less of something, and it's recorded on the right side of the balance sheet. Example, purchasing lettuce for Bun Bites. Let's say Bun Bites buys lettuce for $285. Without accounting knowledge, one might note, lettuce cost $285. An accountant, however, will detail it as, debit, Bun Bites now has $285 more in lettuce, an asset increase. Credit, Bun Bites has $285 less in cash, an asset decrease. It's essential to understand that the debit, incoming value, always matches the credit, outgoing value, ensuring they balance each other out. Accounting is all about tracking these ins and outs across 5 areas: assets, things you own, liabilities, debts, expenses, costs, income, money you make, and equity, ownership value. For the electricity bill, a non-accountant would just note, electricity cost $200. An accountant, though, would write that the business has $200 more in expenses, debit, and $200 less in cash, credit, because they paid the bill. That's how all the money moves are kept in check. Let's make the computer purchase example easy to understand. Imagine a business buys a computer for $2,500. If you're not an accountant, you might just write computer costs $2,500. But an accountant will split it into 2 parts. They'll say the business has $2,500 more in computers, debit, because they now have an extra computer, and $2,500 less in cash, credit, because they paid for it. Now, about the rules of debit and credit. They're simple and always the same. If something the business owns, like a computer, goes up in number, you debit it. If it goes down, like when you spend cash, you credit it. So, if the restaurant had 1 computer and bought another, they now have 2, which means their computer assets went up. That's a debit because it's an increase in what they own. When the business spends cash, like paying for electricity or a computer, the amount of cash they have goes down. For example, if the business had $4,000 and they spent $2,500 on a computer, now they have $2,500 less. This reduction in cash is noted as a credit. Now for liabilities, debts, equity, ownership value, and income, money made. It's the reverse of assets, things owned, and expenses, costs. If debts, ownership value, or money made go up, it's a credit. If they go down, it's a debit. Expenses work just like assets. So, if you spend more, expenses go up, or if you own more, assets go up, that's a debit. But if you owe less, liabilities go down, or make less money, income goes down, that's also a debit. It's like 2 sides of a coin, where one side is assets and expenses, and the other side is liabilities, equity, and income. They follow opposite rules for debits and credits. There are 5 main things to track: assets, liabilities, equity, income, and expenses. Assets are what you own, like computers or cash. Liabilities are what you owe, like a loan. Equity is the value of your ownership in the business. Income is the money you make from selling things, and expenses are the costs of running your business, like electricity or buying supplies. Assets, liabilities, and equity are shown on a report called the balance sheet. It's like a snapshot of the business's financial health. Income and expenses go on a different report called the income statement or profit and loss statement, which shows if the business made a profit. For assets and expenses, when they increase, you debit them, and when they decrease, you credit them. It's the opposite for liabilities, equity, and income. You credit when they increase and debit when they decrease. So, if you spend more, expenses go up, or own more, assets go up. That's a debit. But if you owe less, liabilities go down, or make more money, income goes up. That's a credit. Just remember, more assets or expenses, debit, more liabilities, equity, or income, credit. Debit and credit basics. When expenses or assets go up, we use debit. Everything else, liabilities, equity, or income, follows the opposite rule, credit when they increase. If expenses or assets decrease, it's a credit. Common balance positions. For most accounts, assets and expenses usually have a debit balance, meaning more debits than credits. Liabilities, income, and equity usually have a credit balance, more credits than debits. Understanding the categories. Assets. These are things the business owns, like cash, computers, or inventory. Liabilities. These are debts or what the business owes, like loans or bills. Equity. It's the value of the owner's share in the business. Income. Money made from selling goods or services. Expenses. Costs of running the business, like rent or salaries. Remember, it's like a seesaw. More assets or expenses, debit, more liabilities, equity, or income, credit. Now, let's dive deeper into each category. What an asset? Thinking about assets. When you hear the word asset, what comes to mind? Maybe it's your house, especially if you fully own it without any loans or mortgages. You can live in your house comfortably. Or perhaps you're thinking about the money you have in the bank. That money can buy things, maybe even a bit of happiness. Your car or bike is also an asset. You ride it to places, and it helps you get to work. Plus, it brings in money in the form of salary or wages. What is an asset? An asset is something you own or possess. You expect to use it or benefit from it in the future. According to International Financial Reporting Standards, IFRS, an asset is a present economic resource controlled by the business because of past events. It's something that has the potential to bring economic benefits. IFRS stands for International Financial Reporting Standards. They're like rules for businesses all over the world to prepare their money reports in the same way. This is super helpful because it lets people compare different businesses no matter where they are. Imagine you're thinking about investing in a business in Canada, but there's also one in the UK that looks good. You want to check their financial reports to see which one's doing better. If they both use IFRS, it's like they're speaking the same financial language. So, you can trust the numbers and make a good choice. If they had different rules, it would be like trying to compare apples to oranges, and that could lead to wrong decisions. What are International Financial Reporting Standards, IFRS? IFRS are like rules for businesses all over the world to prepare their money reports in the same way. The goal is to make financial statements consistent, transparent, and easily comparable across different countries. They're super helpful for auditing, tax purposes, and investing. Where are IFRS used? IFRS are required or allowed in 132 countries globally. Some big ones include Australia, Canada, the European Union, India, and South Africa. But interestingly, the United States and India don't require IFRS. They use different accounting rules. Geographies using IFRS. In Africa and the Middle East, many countries, highlighted in red, need IFRS for reporting, especially for listed companies. Some other countries, highlighted differently, permit IFRS. Remember, IFRS helps everyone speak the same financial language, no matter where they are. Asia. India and China don't currently require IFRS, but countries like Pakistan and Australia do use IFRS. Europe. IFRS is heavily adopted in Europe. Many European countries currently require IFRS. Americas. In South America, many countries have adopted IFRS. However, in North America, the United States hasn't fully adopted IFRS yet. Remember, IFRS helps businesses speak the same financial language worldwide. IFRS and domestic companies. IFRS, International Financial Reporting Standards, isn't always required for domestic public companies. In the United States, they follow a different set of rules called US GAAP. However, IFRS is allowed for listings of foreign companies. For example, more than 500 foreign companies registered on the SEC, US Securities and Exchange Commission, use IFRS. India's approach. In India, there's no strict requirement to use IFRS. India has its own accounting standards, which are quite similar to IFRS. What are assets? Let's focus on assets. According to IFRS, an asset is a present economic resource controlled by the entity, the business, due to past events. An economic resource is something that can bring economic benefits. Remember, assets are like tools. They help businesses achieve their goals and make life easier. What is an asset? An asset is something you own or control. It has the potential to provide future economic benefits. Key points. It's an economic resource, something that brings financial benefit. The entity, organization, controls that asset. The economic resource can produce benefits in the future. Not all benefits count. It's important to note that an asset isn't just any benefit you've already received. It's about future potential. Let's look at examples to make this clearer. Common assets. The list you see covers most of the assets encountered in accounting. As an accountant, you'll work with these assets a lot. Cash at hand or bank. Cash, the money you physically have or the money in the bank, is an asset. The business controls it and can use it for future benefits. For example, the company can buy stock, pay rent, or cover utilities. Cash is like the ultimate asset because many other assets eventually turn into cash. Building or office. The building where the business operates is also an asset. It's a place where the business can create value and serve customers. Computer hardware and furniture. Computer equipment, like desktops and office furniture, chairs, desks, etc., are also assets. Employees use them to work, and they contribute to the business's productivity. Inventory. Inventory is all the stuff a company plans to sell. It's an asset because it's expected to be sold and bring in money later on. Baikless. Vehicles used for business, like delivering products or getting employees to work, are assets too. Machinery. If a company makes things, all the machinery they use is an asset. Land or property. Any land or buildings the company owns are definitely assets. Accounts receivable. This is money that customers owe the company. It's an asset because it will turn into cash when the customers pay up. Prepayments. Prepayments are amounts a company pays in advance. They haven't received the service or product yet, but they will in the future. So, prepayments are also an asset because they'll benefit from that service or product later. Investments. If a company invests in other companies, like buying shares or putting money in the bank, those are assets too. These investments can be turned into cash. Computer software. When a company buys computer software, like ERP systems such as SAP or Oracle, it's an asset. They'll use it to manage their business. Goodwill. When a company buys another business, they might get something called goodwill. Goodwill represents the positive reputation, customer loyalty, or other intangible benefits from that business. It can lead to more profits or cash flow for the company. The value of goodwill is usually determined and recorded as an asset in the company's books. Trademarks, patents, and copyrights. If a company buys trademarks, like logos, patents for inventions, or copyrights for creative works, those are also considered assets. These protect the company's unique ideas and creations. Types of assets. Here's a list of assets you'll encounter in real life. Now, let's look at the types of assets. Categories of assets. There are 3 main categories based on time and tangibility. Current assets. These are things like cash and cash equivalents. Cash equivalents are short-term investments that can be quickly turned into cash if needed. Current assets are expected to be converted into cash within 12 months. Long-term assets. These are assets that won't be turned into cash quickly. They take longer to realize. Tangible versus intangible assets. Tangible assets are physical things like buildings or machinery, while intangible assets are things like patents, trademarks, or copyrights. Normal operating cycle. The normal operating cycle is like the business cycle. It's the average time it takes for a company to buy something, sell it, and receive cash. Assets that are usually sold or used up within this cycle include inventory, the stock a company has, and accounts receivable, the money customers owe for things they bought. Cash and cash equivalents. These are assets that include the money you have on hand or in the bank. They also include things like short-term investments that can quickly turn into cash. Current assets. Current assets are things like cash, inventory, stuff to sell, and accounts receivable, money customers owe you. These are expected to turn into cash within a year or during the normal business cycle. Prepayments. Prepayments are payments made in advance for services or products you'll get later. Most of the time, these are short-term, but sometimes they can be for a longer period. Investments. Investments can be short-term, current, or long-term. It depends on when the investment is expected to pay off or mature. Remember, understanding assets helps you keep track of what the business owns and expects to benefit from in the future. Where do we find assets? Assets are listed in a financial report called the balance sheet. Balance sheet example, Raymond. Raymond's balance sheet shows all their assets as of May 31st, 2022. You might wonder why it's not December 31st. That's because companies can choose any month to end their financial year. For Raymond, it's May 31st. Understanding Raymond's balance sheet. The balance sheet has two main parts: assets and liabilities and equity. On the asset side, you'll see current assets, like cash or inventory, listed with how much they're worth. Below that, there are non-current assets, like buildings or equipment, which are things Raymond plans to use for a long time. Non-current assets. Non-current assets are all the things a company owns that aren't current assets. These are items the company plans to use or turn into cash over a period longer than 12 months. Examples of non-current assets. Buildings and offices are long-term assets because they benefit the company for many years. Computer hardware, furniture, and equipment can last a really long time, like 15 to 25 years. Vehicles and machinery are also used for more than a year. Land can be owned indefinitely, and long-term investments are considered non-current assets. Computer software, goodwill, trademarks, patents, and copyrights are all non-current assets because they provide value over a long period. Finding non-current assets in financial statements. You'll find non-current assets listed on the balance sheet. For example, in Raymond's balance sheet, you can see non-current assets at the bottom with their values. Intangible assets. Intangible assets are things a company owns that you can't touch or see. They can be made by the company or bought from someone else. If a company makes its own intangible assets, they usually don't put a value on them in their books. These assets can last for a set time, definite, or an unknown time, indefinite. Examples of intangible assets. Things like computer software, goodwill, the value of a company's brand and reputation, trademarks like a logo, patents, rights to inventions, and copyrights, rights to creative works, are all intangible assets. They're all non-physical, which is why they're called intangible. Why current and non-current matter. Knowing if assets are current, short-term, or non-current, long-term, is super important when looking at financial ratios. It helps us figure out which assets and liabilities will be dealt with soon, within 12 months, and which will be around for longer. This info is key to understanding a company's financial health right now. Remember, intangible assets are like the invisible tools that add value to a business over time. Intangible assets. Intangible assets are things a company owns that you can't touch or see. Examples include computer software, goodwill, the value of a company's brand and reputation, trademarks, patents, and copyrights. These assets are valuable even though they don't have a physical form. Liabilities. A liability is a present obligation of the company. It arises from past events. For example, a bank loan creates a liability, the obligation to pay off the loan. Remember, understanding intangible assets and liabilities helps us see the full financial picture of a company. Liabilities. What are they? Liabilities are what the company owes to others. Think of them as the bills and debts that need to be paid. Accounts payable. Accounts payable is like the opposite of accounts receivable. It's the money the company needs to pay to its suppliers. For example, if a company buys supplies and the supplier gives them 30 days to pay, that money owed is called accounts payable. Accrued liabilities. Accrued liabilities are expenses that have happened but haven't been billed yet. Let's say a company used electricity all January but didn't get the bill by the end of the month. They still record the expense because they know they'll have to pay it later. Remember, keeping track of liabilities helps a company manage its money and pay off what it owes on time. Accrued salaries and wages. Imagine a company pays its employees every 2 weeks. At the end of January, the employees have worked for 10 days that they haven't been paid for yet. The company will pay for these 10 days in February. But in their books, they'll write down the cost of these 10 days in January because the work was done then. Taxes and debts. Taxes the company needs to pay the government are a liability. Long-term debt is money the company borrowed and has to pay back over time. The part of the debt that needs to be paid within the next year is called the current portion of long-term debt, and it's also a liability. Remember, keeping track of what the company owes, like salaries and loans, helps them manage their finances properly. Deferred revenue. Deferred revenue is money a company gets from customers before the company has provided a service or product. It's like a promise to do something for the customer in the future. Bank overdrafts and short-term debts. A bank overdraft is when a company spends more money than it has in its bank account. The bank covers the extra, but the company has to pay it back, so it's a liability. Short-term debts are like smaller loans that need to be paid back soon, and they're also liabilities. Raymond's balance sheet, liabilities and equity. On Raymond's balance sheet, you can see all the money Raymond owes, liabilities, and the value that belongs to the owners, equity. The top part lists all the liabilities with the amounts in dollars as of May 31st, 2022. Remember, liabilities are like the bills the company needs to pay, and equity is like the value that owners have in the company. Current liabilities. These are short-term obligations due within 12 months or the normal operating cycle of a business. Examples include accounts payable, money owed to suppliers. Accrued liabilities, expenses incurred but not yet billed, like salaries or utilities. Taxes payable, taxes owed to the government. Short-term debt, smaller loans that need to be paid back soon. Non-current liabilities. These are long-term obligations not due within a year. Examples include deferred revenue, money received in advance for services or products yet to be provided. Long-term debt, larger loans that need to be paid back over time. Contingent liabilities, obligations dependent on uncertain future events, like lawsuits or warranties. Remember, understanding liabilities helps businesses manage their financial responsibilities. Equity is like the leftover value of a company after you subtract all the debts, liabilities, from what it owns, assets. It's the ownership part of a company. Imagine a company as a big piggy bank. If the piggy bank only had money, assets, and no bills to pay, liabilities, then everything inside would belong to the owners. That's equity. But usually, companies have to pay bills or have loans, liabilities. So, equity is what's left after paying off those bills. It's like saying, after we pay everyone we owe, this is what we, the owners, get to keep. So, equity equals assets, things like buildings, computers, money owed by customers, liabilities, debts, and bills. It's the true value that belongs to the company's owners. Equity is like a company's savings account. It's the money that belongs to the people who own the company, the shareholders, after all the debts, liabilities, are paid off. Here's how it works. Assets are everything the company owns, like buildings, money, and stuff they sell. Liabilities are all the money the company owes to others, like loans or bills. When you subtract liabilities from assets, you get equity. Equity shows the value of the company that the shareholders own. It includes ordinary shares. These are the common shares that people buy and own in a company. Preference shares. These are special shares that might pay dividends before ordinary shares. Accumulated retained earnings. This is all the profit, or loss, the company has made over the years and kept in the business instead of giving it out as dividends. So, if a company has been around for 10 years, all the profits it's made and kept during that time are its accumulated retained earnings. The balance sheet equation is a key concept. It tells us that what a company owns, assets, is always equal to the sum of what it owes, liabilities, and its net worth, equity. In other words, equity is what's left after subtracting liabilities from assets. We can also flip this around to say that assets are the total of liabilities and equity. Take Raymond's balance sheet as an example. On one side, we have assets totaling $40.3 billion. On the other side, we have liabilities and equity adding up to the same amount, $40.3 billion. This includes money owed to others, liabilities, and the value belonging to shareholders, equity, which also includes profits that haven't been distributed, retained earnings. Looking at last year's numbers, both assets and the combination of liabilities and equity were $37.7 billion. This shows that the balance sheet is balanced. The value of assets is always equal to the combined value of liabilities and equity. Just like we saw with Raymond's financial statements, the numbers match up perfectly. Equity is part of the balance sheet, and you'll usually find it in the section that lists liabilities and equity together. Here, you'll see the total amount of liabilities, what the company owes, and the shareholders' equity, the value that belongs to the owners. These are the specific details that show the equity on the balance sheet. After understanding the balance sheet with its assets, liabilities, and equity, it's time to look at the income statement, which includes income and expenses. Let's define income first. It's anything that increases the company's assets or decreases its liabilities, which, in turn, increases the company's equity. So, we've already talked about assets, what the company owns, liabilities, what the company owes, and equity, the owner's share of the company. Income is just an increase in the company's assets. It could be from earning more money or owing less, but either way, it always ends up boosting the company's equity. When we talk about a company's equity increasing, we don't count the extra money that owners or shareholders put in by buying more shares. That's not considered income. However, any other business activity that makes the company more profitable and increases equity is counted as income. Expenses are just the opposite of income. They are costs that reduce the company's assets or create debts, which lower the company's equity. But this doesn't include money put in by the owners or shareholders. Here's the main point. Income makes the company's equity go up because it's profit. Expenses make equity go down because they're costs. Income is the money a company gets or will get from selling things, providing services, or making investments. It can mean more cash for the company or less debt. For example, if a company owes money for a bill that hasn't come yet, like a January bill recorded in January but received later, that's a liability that will decrease once paid. Imagine a company gets a bill that's less than what they expected. This means the company doesn't owe as much as they thought, so their liability decreases. The difference between the estimated expense and the actual lower bill counts as income. Income boosts the company's equity or profits. In accounting, when income goes up, it's recorded as a credit. When it goes down, it's a debit. For example, when a business sells burgers for cash, it gets more cash, which is an asset. The accounting record would show a debit for the cash received and a credit for the sale of burgers, which is the income or revenue. This is how income is recorded, following the double entry system where every transaction affects two accounts. So, when cash increases, income also increases, but is recorded as a credit. The cost of making the burgers sold is also recorded following the matching principle, which we'll talk about more in a different section. Income includes various things. Sale of goods. When a company sells products, the money they receive is considered income. Service income. If a company provides services, like consulting or repairs, the money they earn from those services is also income. Dividend income. This comes from investments in other companies. If a company owns shares in another business and receives dividends, a share of the profits, that's income. Interest income. When a company earns interest on loans they've given or on investments, like bonds, it's considered income. Rental income. If a company owns property, like buildings or land, and rents it out to others, the rent they receive is income. Gain on sale of assets. When a company sells something they own, like equipment or property, and makes a profit, that profit is also considered income. Expenses, on the other hand, are costs the company incurs. When you pay for something, like buying supplies or paying employees, it's an expense. This reduces the company's assets, like cash. Expenses can also increase liabilities. For example, if a company buys something on credit, meaning they'll pay later, they record an accounts payable liability. Overall, expenses decrease the company's equity or profit. They're recorded as debit entries when they increase and credit entries when they decrease. When a business pays for something, like the rent for their building, it's an expense. In accounting, they write this down as a debit for rent, the expense, and a credit for cash, the asset they use to pay. This means the business has less cash now. There are many types of expenses, such as salaries, training costs, meals, rent, cleaning, office supplies, and utilities like electricity and water. Other expenses include repairs, maintenance, taxes, interest, depreciation, the loss of value of things over time, insurance, leases, rental equipment, and travel costs. All these expenses are money going out of the company, which reduces both the company's assets and its profits, negatively affecting the equity. Now, if we look at Raymond's income statement, we see all the income and expenses listed. Income includes revenues and other income. On the income statement, if other income is a negative number, it's shown in brackets, indicating it's actually an expense. So, the lines for revenues and other income show the money coming in, and everything else listed is an expense. The cost of sales is the cost of making and selling Raymond's products. Then there are demand creation expenses, which are costs to promote and advertise the products. Operating expenses are the day-to-day costs of running the business. There's also interest expense, which is the cost of any borrowed money, and tax expense, which is the money paid to the government. All these are expenses, and when you subtract them from the income, you get the net income. It's like the final score after all the costs are paid. So, for the year ending on May 31st, 2022, Raymond had a net income of about $6 billion. We've covered all the important parts of financial statements: assets, liabilities, equity, income, and expenses. Remember, assets, liabilities, and equity are part of the balance sheet, while income and expenses are part of the income statement. Now, let's dive into some accounting principles. These principles guide how financial statements are prepared and how accounting entries are made. Here are a few key principles we'll discuss. 1. Accrual principle. This says that transactions should be recorded when they happen, not just when the cash changes hands. For example, if a company provides a service but hasn't been paid yet, it's still recorded as income. 2. Matching principle. This principle ensures that expenses are matched with the related income. If a company sells products, the cost of making those products, the expense, should be matched with the revenue from selling them. 3. Consistency. Companies should use consistent accounting methods from year to year. This helps make financial statements comparable over time. 4. Cost or historical cost principle. Assets are recorded at their original cost, not their current market value. This principle keeps things straightforward. 5. Going concern. This assumes that the company will continue operating for the foreseeable future. It's essential for preparing financial statements. 6. Materiality. Only significant information should be included in financial statements. Small details can be left out. 7. Revenue recognition. This principle guides when and how revenue, income, is recognized. It's important for showing the company's financial performance accurately. Remember, there are more accounting principles, but these are some of the key ones we'll explore. The accrual principle is an essential accounting rule. It says that we should record transactions when they actually happen, not just when cash is paid or received. This is different from the cash basis of accounting, where transactions are recorded only when cash changes hands. Here's an example. Imagine you pay the electricity bill for January and February. According to the accrual principle, you should record the expense in January. Why? Because the service, electricity, was provided in January, even though you didn't get the bill until later. So, we record the expense in the period when it actually occurred. Sometimes, if you don't have the exact bill amount, you can make an estimate. The goal is to show financial statement users, like investors or managers, when expenses truly happened, even if the cash flow doesn't match exactly. The matching principle is another important accounting rule. It's somewhat similar to the accrual principle. Here's what it says: match revenue and expenses, or costs and benefits, so that they are recorded in the same period. For example, when a company buys something to sell, like mobile phones, they should record the expense, cost of sales, in the same period as when they record the sales revenue. Let's say the company bought 10 mobile phones in January, but they actually sold those mobile phones in February. According to the matching principle, they should match the cost of buying those phones with the revenue from selling them in the same period. This helps show a more accurate picture of the company's financial performance. Even if a company buys something, like mobile phones, and pays for them in January, they won't count it as a cost of sales yet. Instead, they'll list the phones as inventory, which is an asset, not an expense. The phones only become an expense when they're actually sold. This matches the matching principle, which says costs should be recorded in the same month as the sales. So, when the company sells the phones and gets money from customers, that's when they'll also record the cost of those phones. This way, the income from sales and the expenses match up in the same period. If they didn't do this, they'd have the cost showing in January and the income in February, which would give a confusing picture of the company's finances. Depreciation is like spreading out the cost of something big, like furniture, over the time you use it. If a company buys furniture and decides it will last for 10 years, they don't count the whole cost as an expense right away. Instead, they spread the cost over 10 years, which matches the time they'll use it. This is part of the matching principle, linking expenses to the time they help earn money. The cost principle, or historical cost principle, tells us to write down the price we paid for something, like a car, and not change it even if the car's value goes up or down over time. So, if a company buys a car, they'll record what they paid for it and then use depreciation to spread the cost over the years they use it, without worrying about the car's current market value. This keeps the accounting simple and consistent. Remember, the historical cost principle doesn't work for everything. For example, it doesn't apply to short-term investments. Also, we can't use it for things that didn't cost us anything in a transaction, like a brand or goodwill that we created ourselves. The going concern principle is also key. It's based on the idea that a business will keep running for the foreseeable future. We don't think it will close down soon. Because of this, the business is expected to keep making sales and profits. So, we keep the value of assets as they are in the books, which is their original cost minus any depreciation. But if the business was going to stop operating or be sold, then the value of the assets might need to be changed because their worth could be different from the historical cost. Imagine a business has a specific piece of machinery that originally cost a lot, but now no other businesses need that machinery and there are no buyers for it. If the business is shutting down, the value of that asset becomes inflated, it's overstated. The reason is that the expected economic benefits from that machinery won't happen anymore. The only way that machinery would benefit us is if we kept the business running and the machinery continued to produce goods. But now, since we're discontinuing the business, we won't use that machine, and no one else wants it either. Maybe we can sell it as scrap, which is its true value. In this case, we need to adjust the value of the assets downward. So, unless there's a clear intention from management to sell or discontinue the business, we follow the going concern assumption. This means we keep the assets carrying value, original cost minus depreciation, as valid in the books. This principle is crucial, and external auditors pay attention to it when they review a company's financial statements. They assess whether the company can present its financial statements with the assumption that the business will continue operating. The materiality principle is important. It says that if an amount is too small to affect decisions made by investors or decision makers, then misclassifying or leaving it out won't be a big deal. Here's an example. Imagine there's an asset, a calculator, with a useful life of 10 years, and it only cost $25. Some calculators last a really long time. According to the materiality principle, we can choose to expense that asset right away. Instead of treating it as an asset, we record it as an expense in the income statement. This is allowed. So, we don't have to match the useful life of the asset with how we allocate its cost. This principle is kind of an exception. If the amounts are small enough, we can ignore some other accounting rules. Materiality depends on the size of the organization. For very large companies, what's considered small or immaterial will be larger. But for smaller organizations, even smaller amounts matter based on this principle. Recording small asset costs. Many organizations have a policy to treat assets costing less than a certain amount as expenses. For example, if an asset costs less than $5,000, even if it has a useful life of more than a year, it's immediately recorded as an expense in the month of purchase. This helps keep accounting straightforward for small items. Revenue recognition principle. This principle says we should record revenue when goods or services are delivered, regardless of when cash is received. It combines the accrual and matching principles. For example, when a product is sold on credit, revenue is recorded when the product is delivered, not when cash is received. Projects and percentage of completion. When revenue is related to a long project, it's recorded based on the percentage of completion, not when payments are received. Even if a company receives advance payments, e.g., 50% upfront, for a project, they'll record revenue based on how much of the project is completed. Specific guidelines exist for recording revenue according to the percentage of completion principle. Consistency principle. We should consistently apply accounting principles, policies, and methods unless a better approach is available. This helps users of financial statements understand the business's performance over multiple periods. If a company changes its accounting policies or principles, it may affect how accounting entries or assets and liabilities are treated. When we talk about money coming in and going out in financial statements, it's important for decision makers to be able to compare these numbers over different time periods. For example, when a company buys something that will last for 10 years, they can spread out the cost over those 10 years using the straight line method of depreciation. This means they divide the total cost by 10 and record that fraction as an expense each year. Or they might use the reducing balance method, where they record more expense in the early years and less later on. Once a company picks a method, they should stick with it for consistency, unless there's a really good reason to change. Also, companies set a limit for what they consider a small expense. If something costs less than this limit, they record it as an expense right away, not as an asset. This limit shouldn't change often to keep things consistent. Now that we've got a good grasp of assets, liabilities, equity, income, and expenses, and some key accounting principles, it's a great time to practice making accounting entries. After practicing, we'll see how these entries fit into the bigger picture, like the general ledger, trial balance, and finally, the balance sheet and income statement. Are you ready to try out what you've learned about accounting rules and principles with some real examples? Let's start with a common situation. A business owner puts $30,000 into the company's bank account as their initial investment, which is also called equity. This is usually one of the first things done when starting a new business. In accounting, every transaction affects two accounts. For this transaction, the two accounts are cash, or money in the bank; owner's equity, the owner's share of the company. When the owner deposits the money, the cash in the bank goes up. So, cash is increasing. At the same time, the owner's equity in the business is also increasing because the business now has money to start with. Before the deposit, the business had no money, and now it has $30,000. That's how both cash and owner's equity go up by the same amount. In accounting, cash is considered an asset because it's something valuable that the company owns. Equity is the owner's share of the company. When the owner puts money into the business, both the cash, asset, and the owner's equity increase. Here's a quick rule in accounting. If an asset increases, we record it as a debit. If equity increases, we record it as a credit. So, when the owner deposits $30,000 into the business, the accounting entry would be debit cash $30,000 because the business now has more cash. Credit owner's equity $30,000 because the owner's share of the business has increased by that amount. This is how we record the owner's investment in the business. Ready for the next example? The company is buying furniture and paying $10,000 in cash for it. So, what's going on with the accounts? We have two accounts affected here: furniture and cash. The furniture account goes up because the company now has more furniture worth $10,000. But the cash account goes down because the company is spending cash to buy the furniture. Both furniture and cash are assets. When an asset increases, like the furniture account, we record it as a debit. When an asset decreases, like the cash account, we record it as a credit. So, the way to write this down in accounting would be debit furniture $10,000 because we have more furniture. Credit cash $10,000 because we have less cash. This follows the basic rules of accounting, where there's always a balance. What comes in must be balanced by what goes out. The company is getting more furniture, and this time they're not paying cash upfront. Instead, they're buying the furniture on credit, which means they'll pay later. So, they get the furniture now, but they owe money for it. This is where the accrual principle comes into play. Even though no cash is paid yet, the company still has to record the obligation to pay as a liability. In accounting terms, the furniture account increases because the company has more furniture. At the same time, the accounts payable, the money they owe, also increase. So, for this transaction, we would debit furniture $10,000 because we have more furniture. Credit accounts payable $10,000 because we now owe that much for the furniture. This shows that for every transaction, there's always something that goes up, debit, and something that goes up on the other side, credit, keeping everything balanced. The company is settling the amount they owed for the furniture. Here's how we record this. Account payable, the liability from the previous entry, decreases because they're paying it off. Cash, an asset, decreases because they're using cash to settle the debt. So, the accounting entry would be debit account payable $10,000 because it's decreasing. Credit cash $10,000 because cash is going out. This keeps everything balanced, following the rules of debit and credit. The company pays $1,200 in rent for the building. Here's how we record this. Rent expense, the cost of renting the building, increases because they're paying it. Cash, an asset, decreases because they're using cash to pay the rent. So, the accounting entry would be debit rent expense $1,200 because it's increasing. Credit cash $1,200 because cash is going out. This keeps everything balanced, following the rules of debit and credit. The company got $500 as dividend income from an investment. This means the company had put money into another company and now it's getting a part of that company's profits. So, what changes in the company's accounts? Cash. This increases because the company received $500. Dividend income. This is the income account that goes up because the company earned $500 from its investment. In accounting, when cash, an asset, increases, we debit it. And when income increases, we credit it. So, the accounting entry for receiving the dividend would be Debit cash $500, more money in the bank. Credit dividend income $500, shows the income earned. This way, the company's books reflect the extra money it now has. The company buys 10 bicycles to sell later and pays $5,000 in cash. The two accounts affected are inventory. This is where the bicycles are recorded because they're assets that the company plans to sell. Cash. This decreases because the company is spending money. So, the company's inventory of bicycles increases and its cash decreases. The accounting entry for this would be debit inventory $5,000, more bicycles in stock. Credit cash $5,000, less cash because it was spent. These bicycles aren't an expense yet because they haven't been sold. They're an asset, something the company owns that can make money later. When the company sells the bicycles, that's when they'll record the cost as an expense. This matches the matching principle in accounting, which says to record expenses in the same period as the income they help generate. Now, the company sells 5 of the 10 bicycles for $4,000 in cash. This is when they'll see income from the sale and record the cost of the bicycles sold as an expense. The accounting entry for the sale would be debit cash $4,000, more cash from the sale. Credit sales revenue $4,000, income from selling the bicycles. This way, the company's financial records show both the new cash coming in and the income earned from selling the bicycles. The company is selling 5 bicycles for $4,000. They bought these bikes for $5,000 for 10 bikes, so each bike cost $500. They're selling each bike for $800, making a profit of $300 per bike. Here's what happens in the company's records. First entry, recording the sale. Cash goes up because the company gets $4,000. Sales or income also goes up by $4,000 because they've made sales. The accounting entry is debit cash $4,000, more cash. Credit sales $4,000, more income. Second entry, recording the cost of sale. Cost of sales goes up because they need to account for the cost of the bike sold. Inventory goes down because they have 5 fewer bikes. The accounting entry is debit cost of sales $2,500, the cost of 5 bikes. Credit inventory $2,500, 5 bikes sold. This follows the matching principle, where the cost of the bikes is matched with the sales revenue. The company records the sale and the cost at the same time to show the profit correctly. When the company sells bicycles, there are 2 important entries. Sale entry. Cash goes up because the company receives money from selling the bikes. Sales, or income, also goes up by the same amount because they've made sales. The accounting entry is debit cash $4,000, more cash. Credit sales $4,000, more income. Cost of sale entry. Cost of sales goes up because they need to account for the cost of the bike sold. Inventory goes down because they have 5 fewer bikes. The accounting entry is debit cost of sales $2,500, the cost of 5 bikes. Credit inventory $2,500, 5 bikes sold. This follows the matching principle, where the cost of the bikes is matched with the sales revenue. Both entries impact the company's profit and ultimately its equity. Bicycle. Now, let's understand how accounting entries flow through a company's records. Imagine we've practiced 9 accounting entries using the double entry system. Here's how they move through the accounting process, especially in modern times when most accounting is done using computer systems. Journal entry, or accounting entry. This is where it all begins. Each transaction is recorded in the journal or accounting entry. For example, when the company sells bicycles, we record the sale and the cost of sale. General ledger. The journal entries are summarized in the general ledger. This is like a big book where all the transactions are organized by account. For instance, the cash account shows all the cash transactions, and the inventory account shows all the bicycle-related transactions. Trial balance. From the general ledger, we create a trial balance. This is a list of all the accounts and their balances, like the total cash, inventory, etc. It helps us check if the debits and credits match. Financial statements. Finally, we use the trial balance to prepare financial statements. These include the balance sheet, which shows assets, liabilities, and equity, and the income statement, which shows income and expenses. For example, the balance sheet will show how much cash and inventory the company has, and the income statement will show the profit or loss. This flow ensures that every transaction is properly recorded and helps us understand the company's financial position and performance. Journal entries are like a diary for business transactions. They're written down in the order they happen, with the date and time. Back before computers, if you were an accountant, you'd have a physical book called a journal. You'd write down every business transaction in this book as it happened. This way, everything was organized by when it occurred, which is what we mean by chronological order. It's like keeping track of events in a timeline. In the example of the Board Bikes Company, we've recorded several accounting entries for the month of January. Let's see how these entries flow through the accounting process. Journal entries. These are like the diary entries for each transaction. They're recorded in chronological order based on the date. For example, on January 1st, the owner invested $30,000 and the entry was cash, debit, owner's equity, credit. General ledger. The journal entries are summarized in the general ledger. This big book organizes transactions by account type or account number. For instance, the cash account, account number 1100, shows all cash-related transactions. Trial balance. From the general ledger, we create a trial balance. This lists all accounts and their balances. It helps us check if the debits and credits match. For example, the cash account shows the total cash balance. Financial statements. Finally, we use the trial balance to prepare financial statements. These include the balance sheet, which shows assets, liabilities, and equity, and the income statement, which shows income and expenses. For example, the balance sheet will show how much cash and inventory the company has, and the income statement will show the profit or loss. The final balance is calculated by adding up all the debits and credits for each account. If the debits and credits match, the books are balanced. This process ensures that every transaction is properly recorded and helps us understand the company's financial position and performance. Imagine a new company that just started its business. Here's what happened during the month of January. 1. Cash account. At the beginning of the month, on January 1st, the cash account had no money in it, a balance of 0. Then, the company received some money, which increased the balance to $30,000. Later, there was a payment that reduced the balance by $10,000, leaving $20,000 by the end of the month. 2. Inventory. Initially, there was no inventory, but during the month, the company added $5,000 worth of inventory. Half of this inventory was sold, so the remaining balance in inventory is $2,500 at the end of the month. 3. Furniture. The company purchased furniture twice, spending a total of $10,000. As a result, the furniture balance is $20,000. 4. General ledger. In the company's records, the general ledger, you can see which amounts were added, debited, and which were subtracted, credited. 5. Accounts payable. Initially, there was a balance in accounts payable, money owed to others, but during the month, the company paid off all its debts. So, the closing balance in accounts payable is now 0. 6. Owner's equity. The owner of the business initially deposited $30,000. There were no further changes, so the owner's equity remains the same. 7. Sales. The company made sales totaling $4,000. Interestingly, this is shown as a negative balance because it represents money going out from the company to customers. In summary, the company started with nothing, made transactions, and ended the month with specific balances in cash, inventory, furniture, and accounts payable. The owner's equity remained constant, and sales were recorded as a negative balance. In accounting, a negative balance usually means a credit balance, money the company owes, and a positive balance means a debit balance, money the company owns or has. For example, dividend income. The company earned $500. This is a credit balance because it's money the company will receive. Cost of sales. The company spent $2,500. This is a debit balance because it's money the company paid out. Rent. The company paid $1,200 for rent. This is also a debit balance. When you add up all the debits and credits, they should always be equal. This is how accountants make sure everything is balanced. Now, about the trial balance. It's a list of all the accounts and their balances at a certain time. It's like a snapshot of the company's finances, showing how much money is in each account. Let's simplify the paragraph about the trial balance. Think of a trial balance as a quick snapshot of a company's accounts. It's like a summary that shows us the name and number of each account, whether the account has a debit balance, money the company has, or a credit balance, money the company owes, the total amount of money in each account. For example, at the end of the month, the cash account had $8,300. The inventory account had $2,500. And here's a quick rule of thumb. Assets, like cash and inventory, usually have a debit balance. Accounts payable, money owed by the company, would normally have a credit balance, but in our example, it's 0 because everything was paid off. Owner's equity, the owner's investment in the company, usually has a credit balance. Income accounts, like sales, usually have a credit balance. Expense accounts, like rent or utilities, usually have a debit balance. The trial balance makes sure that all the debits and credits are equal, which means everything is balanced. The trial balance we're looking at is dated January 31st, so it shows the balances of all accounts on that day. If you want to see every transaction that happened, you would look at the journal ledger, which has all the details. Imagine a company called ABC Corporation. During January, ABC Corp had various financial activities. Let's look at what happened. Cash transactions. ABC Corp made several transactions involving cash during the month. These could be things like receiving payments, paying bills, or buying supplies. By the end of January, on the 31st, ABC Corp had a cash balance of $8,300. Trial balance. The trial balance is an important report. It summarizes all the account balances at a specific point in time, in this case, January 31st. It helps us prepare other financial statements. Financial statements. ABC Corp prepares several financial statements. Balance sheet. This shows the company's assets, like cash, inventory and furniture, liabilities, like accounts payable, and owner's equity, the owner's investment in the business. Income statement, profit and loss statement. This summarizes the company's income, like sales, and expenses, like rent and cost of sales. In January, ABC Corp made a profit of $800. Cash flow statement. This tracks how cash moves in and out of the company. Changes in equity and comprehensive income. These are other statements we'll explore later. Balance sheet. Let's focus on the balance sheet. It reflects assets. ABC Corp's assets include cash, $8,300, inventory, $2,500, and furniture, worth $20,000. Liabilities. There are no accounts payable, debts, at the moment. Owner's equity. The owner initially invested $30,000, and the profit of $800 adds to this equity. Retained earnings. This represents the accumulated profits over time. Equation. The total of assets, liabilities, and equity always balances. This is the fundamental accounting equation. Assets equals liabilities plus equity. Let's simplify the paragraph about income statements. Think of an income statement as a report that shows how much money a company made and spent over a certain period, like a month. For example, for the month of January, it would list all the money that came in, like sales, and went out, like costs and expenses. It's like a movie that shows the company's financial activity for the whole month. On the other hand, a balance sheet is like a photo taken at a specific moment in time. It shows what the company owns, assets like cash and furniture, what it owes, liabilities, and the owner's share, equity, on a particular day, like January 31st. So, if the company had $8,300 in cash and $2,500 in inventory on that day, that's what the balance sheet would show. Income statement. It's like a story of what the company earned and spent over time, e.g., the month of January. Balance sheet. It's a snapshot of what the company has and owes at a specific moment, e.g., the end of January. If someone asked about your bank balance right now, that's like a balance sheet. But if they asked how much you've earned over the past year, that's like an income statement. Imagine a store called Quickmart. In January, Quickmart had sales. They sold items worth $4,000. Cost of sales. It cost them $2,500 to buy these items to sell. So, Quickmart's gross profit is $1,500. This is the money they made after paying for the items they sold. Now, Quickmart also had some other costs. Operating expenses. They paid $1,200 for rent. Other income. They received $500 from investments, dividends. After considering all this, Quickmart's net income is $800. This is the final profit, which goes into the balance sheet as retained earnings. It's like their savings at the end of the year. At the end of the year, Quickmart resets all their income and expense accounts to zero, and the $800 profit is saved in the balance sheet. Now, about the cash flow statement. It's similar to the income statement because it shows money movement over time, like a month, not just on one day. It's simpler in our example with only 9 transactions, but in real life, it would include many more. So, Quickmart's financial reports show how much money they made and spent, and how much they saved by the end of January. Let's simplify the paragraph about the cash flow statement. The cash flow statement is like a map that shows where a company's money comes from and goes to. It has 3 main parts. 1. Operating activities. This is the money the company makes from its day-to-day business. For example, if a company called Bold Bikes sells bikes, the money from selling those bikes would be listed here. 2. Investing activities. This is the money spent or made from buying or selling things like buildings, equipment, or investments. If Bold Bikes buys a new store or sells an old one, it goes here. 3. Financing activities. This is the money the company gets from sources like loans or from investors when they buy shares in the company. If the owner of Bold Bikes puts in more money, it's shown here. Each part of the cash flow statement gives us a clear picture of the company's financial health. We'll dive deeper into how this works with other financial statements like the balance sheet and income statement. But for now, just remember these 3 sections and what kind of money goes into each. Direct method versus indirect method. There are 2 ways to prepare a cash flow statement: direct and indirect. Direct method. We look at each individual transaction to see how much cash came in or went out. It's recommended but not easy because we need detailed information. Indirect method. We start with net income from the income statement and adjust for non-cash items. This gives us the cash flow from operations. It's like an indirect way of figuring out cash flow. Cash flow from operations. Cash collected from customers. The company received $4,000 from customers' sales. Cash paid to suppliers. The company bought 10 bicycles for $5,000. Cash outflow. Rent paid. The company paid $1,200 for rent. The net total for operations is minus $2,200. More money went out than came in. Investing activities. The company bought furniture for $20,000, cash outflow. But they also received $500 in dividend income, cash inflow. The net cash flow from investing activities is $19,500. In summary, the cash flow statement helps us see where the money comes from and where it goes. It's like tracking the company's financial footsteps. Let's simplify the paragraph about financing activities. Think of financing activities as the ways a company gets money to start or grow its business. This can be through issuing shares, when the company sells parts of itself to investors. Owner's investment, when the owner puts their own money into the company. For example, if the owner adds $30,000 to the company, that's a positive cash flow from financing activities. Now, let's add up all the money movements. Cash flow from operations, money from everyday business activities. Cash flow from investing activities, money spent or made from investments. Cash flow from financing activities, money from the owner or investors. All these added together give us a final cash balance of $8,300. At the start of the business, there was no money, zero. But during January, the company's cash increased by $8,300. So, at the end of January, the company has $8,300 in cash. It's like filling up a piggy bank that was empty at first, and now it's got $8,300. Let's make this paragraph about cash flow easier to understand. A cash flow statement is like a diary that records all the money that comes in and goes out of a company during a certain time, like a month. It has 3 parts. Operating activities, money from selling products or services. Investing activities, money from buying or selling investments. Financing activities, money from loans or investments by owners. At the beginning of the month, we write down how much money we have. This is our opening balance. Throughout the month, we add or subtract money based on our activities. At the end of the month, we write down our closing balance. This should match the cash amount shown on the balance sheet. Now, about the indirect method of cash flow. We start with the net income, like the $800 profit from our income statement. Then we adjust for money that didn't actually move in or out, like depreciation, which we don't have in this example. We also consider dividend income, which is money earned from investments. We move it from operations to investing activities. Finally, we look at changes in working capital, like money owed by customers, accounts receivable, money we owe to suppliers, accounts payable, and inventory. In short, the cash flow statement tells us how much money we have at the end of the month after all our business activities. When we look at a balance sheet, it helps us figure out the cash flow. For example, accounts receivable. This is money that customers owe the company. If there's no change, like in our example, we don't add anything to the cash flow. Inventory. If the company had no inventory at the end of December, but has $2,500 worth at the end of January, this is considered a negative cash flow of $2,500 because it's money spent on stock. Accounts payable. This is money the company owes to others. If it increases, it's a positive cash flow because the company hasn't paid out cash yet. But in our case, it's zero at the end of the month, so there's no effect on cash flow. This method is called the indirect method because it doesn't track the actual cash moving in and out. Instead, it looks at the changes in the balance sheet to figure out the cash flow. It might sound tricky, but the result is the same as if we tracked every dollar directly. So, the cash used by operations shows a negative $2,200, which matches what we got from adding up the cash flow from operations. We'll talk more about cash flow and other financial reports later, but for now, remember this. No matter which method you use, direct or indirect, the total cash from business activities is the same. The cash from investing and getting money, like loans or investments, is pretty much the same in both methods. At the end of the day, the company has $8,300 more than it started with. This is mostly because the owner put in $30,000. Even though the company spent money on its business and investments, it still has a positive cash flow thanks to the owner's money. When you look at the profit on the income statement, it shows $800 for January. But the cash flow statement tells a different story. The company actually spent $2,200 more than it made from its business. The only reason the cash flow is positive is that the owner added money. From the owner's point of view, he put in $30,000 and now has $8,300, which might seem like a loss of $21,700. But it's not a loss, it's money put into the business. Now, the owner has assets like $20,000 worth of furniture and $2,500 in inventory that can be sold, plus $8,300 in cash. This shows how money moves in a business. Nowadays, with computer systems, many steps are automated. These systems can review entries, adjust balances, and even create financial reports. If you're using such a system, you just enter your transactions and it takes care of the rest, including summarizing them into ledgers and balances. Some systems might even give you the financial statements automatically, but if not, you'll know how to make them using the system.